Are you looking for higher yielding treasuries? If yes, then Treasury Zeros may be something to consider. Hello, Diamond NestEgg members, Super Savers, and course fans. I hope you're healthy and well. Quite a few of you have asked about Treasury Zeros because, as you can see here on Fidelity's website, some maturities of Treasury Zeros, or strips, are paying more than their non-zero counterparts here. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. What are Treasury Zeros? 2. Why are Treasury Zeros also called strips? And 3. Who might want to consider buying Treasury Zeros or strips? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What are Treasury Zeros? As I just mentioned, Treasury Zeros are also known as strips, and I will be using both terms interchangeably throughout this video. Treasury Zeros are zero coupon U.S. Treasury bonds. Zero coupon because they don't pay a coupon, just like T-bills. And just like T-bills, Treasury Zeros are purchased below par value, at a discount to par essentially, with interest only paid at maturity together with the principal repayment. So, let's assume that on day 0 you buy a Treasury Zero, and you pay a purchase price of $95. You buy the Treasury Zero below par value. On the maturity date, sometime in the future, the Treasury Zero matures and you get your principal repayment of $100. You get paid the Treasury Zero's full par value. This means that you earned $5 of interest on this Treasury Zero. As we said, the interest payment and the principal repayment on Treasury Zeros works in the same way as with T-bills. The big difference between the two is that while T-bills have maturities of 1 year or less, Treasury Zeros are available in maturities up to 30 years, which brings us to the 5 important points you need to keep in mind about Treasury Zeros. Strips. 1. As we just explained, Treasury Zeros only pay interest at maturity. They do not pay coupon or interest payments at regular intervals, such as every 6 months. In other words, Treasury Zeros do not generate regular cash flow, except for one final repayment at maturity. 2. Even though you receive the interest payment on Treasury Zeros at maturity only, the IRS will tax you every year on the imputed interest earned. Imputed interest is the difference between the discounted price you paid for your Treasury Zero and the face value you later receive at maturity on a prorated basis. Imputed interest is interest that the IRS considers to have been earned that year on a zero coupon bond, even though you haven't actually received any payments. As such, the IRS requires that you pay tax on the so-called phantom income each year, just as you would pay tax on interest you actually received in any given year from a coupon bond. You can defer or avoid this annual tax on imputed interest by holding your zero coupon bonds in a tax advantage account, such as a traditional or Roth IRA. Important point number 3. Treasury Zeros carry similar advantages to T-bills, T-notes, and T-bonds, such as the lack of credit risk, currency risk, and country risk. Treasury Zeros are also not callable and actually have slightly lower reinvestment risk than an equivalent term coupon-paying T-note and or T-bond, because an investor does not have to think about where and or how to reinvest the coupon payments every 6 months. We'll talk a bit more about liquidity risk as it relates to Treasury Zeros later on in this video. This brings us to point number 4. Treasury Zeros can be very exposed to interest rate risk and inflation risk, and therefore tend to see more price volatility on the secondary market than T-notes and T-bonds. And this is because there are no mitigating interest payments before maturity. With T-notes and T-bonds, an investor would normally get at least some interest payments during the lifespan of the debt. Of course, if you plan on holding your Treasury Zero to maturity, the secondary market price volatility should be less of an issue. Because remember, at maturity, you'll receive the face value of the bond, and therefore the interest payment that is due to you, although the higher inflation risk still remains. Moving on now to important point number 5. All Treasury Zeros are zero coupon bonds, but not all zero coupon bonds are Treasury Zeros. For example, T-bills are another type of Treasury Zeros. Zero coupon agency, municipal, and corporate bonds also exist, but they're generally less well known, less popular, than Treasury Zeros. Points 1, 2, and 5 that we've highlighted here for Treasury Zeros also apply to zero coupon agencies, munis, and corporates. With points 3 and 4, though, it's important to note that zero coupon agencies, munis, and corporates tend to be associated with a bit more risk and price volatility than Treasury Zeros and agencies, munis, and corporates with coupons. And again, that's because there are no mitigating interest payments before maturity, during which time an issuer who is not the U.S. government, which for all practical purposes carries no credit risk, could go bankrupt and never pay out the interest that's only due to the investor at maturity. Like what you've learned about Treasury Zeros so far? Then check out our end of summer bond course sale to learn even more about bond investing, and fast, while bond yields are still at attractive levels. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern Time on Monday, September 1st. Prices will be going up this fall as we are making some significant course updates at the moment. The 10% coupon code BONDS2025 can also be used to purchase bond beginners or bond masters individually. So, now that you know what Treasury Zeros are, let's move on to the next section of today's video. Why are Treasury Zeros also called strips? STRIPS stands for Separate Trading of Registered Interest and Principal of Securities, which coincidentally, or not so coincidentally, sounds like someone has stripped the interest coupons from the principal. The key idea behind Treasury Zeros is that a financial institution, government securities broker, or government securities dealer takes a traditional U.S. Treasury note or bond and separates the principal repayment promise from the ongoing interest payments. Meaning they strip the Treasury note or bond into one principal repayment at maturity plus a number of regular interest payments into separate tradable securities. Now, even though strips are basically created and sold by financial institutions, government securities brokers, or government securities dealers, and never by the Treasury directly, they are understood to be backed by the full faith and credit of the U.S. government, just like any other Treasury security, as we can see from the stamp of approval given to strips on the Treasury Direct website. If you and I want to buy strips, we can only do this via a bank, broker, or dealer, like Fidelity, Schwab, or Vanguard. Unlike T-bills, T-notes, T-bonds, and FRNs, strips cannot be purchased via Treasury Direct. The minimum purchase and sale quantities for strips typically start at $5,000 to $10,000, as strips are generally marketed towards institutional investors. So, you'll often see articles or videos that say that there is a well-traded or liquid secondary market for strips. Just keep in mind that because strips are generally marketed towards institutional investors, the liquidity for strips in retail-sized purchase or sale quantities may be more limited. Let's assume now that the higher minimum purchase and sale quantities on strips are not an issue for you, bringing us nicely to the next section of today's video. Who might want to consider buying Treasury Zeros or strips? In our mind, Treasury Zeros or strips are best suited for a retail investor under the following circumstances. 1. You want a safe investment, one that is guaranteed by the full faith and credit of the U.S. government. 2. You plan on holding to maturity because, again, interest on strips is only paid out at maturity, and secondary market prices for strips can be more volatile than for coupon-bearing Treasury notes and bonds. 3. You do not depend on regular coupon interest payments for income. 4. You can find strips with a higher yield than the equivalent term coupon-paying Treasury note or bond. And or you're more concerned with having a lump sum payment at a specific point in time in the form of the one-time payment at maturity that strips offer. This is what we call liability matching in the industry. For example, if you're planning for a major future expense, such as buying a house or college tuition payments for your children or grandchildren. This way, there's also no noise from regular interest payments, no need to think about what to do with them, where to reinvest them. Plus, the final repayment will be larger as all interest has accumulated into the one final face amount you'll get at maturity. And 5, you do not get very emotional about secondary market price movements. As we've already discussed previously, Treasury Zeros can be very exposed to interest rate risk and inflation risk, and therefore tend to see more price volatility on this secondary market than T-notes and T-bonds. So, if you're someone whose mind and heart beats with the market's every move, strips may not be the best option for you. If, on the other hand, you've gone through this list and it seems like Treasury Zeros might indeed be a good fit for your personal situation, then it may make sense to check with your broker to see how yields on strips compare with those on T-notes and T-bonds at the time you're watching this video. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to take advantage of the current attractive bond rates before they potentially come down, then check out this video here on our bond courses. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before midnight Eastern Time on Monday, September 1st. Prices will be going up this fall as we are making some significant course updates at the moment. The 10% coupon code BONDS2025 can also be used to purchase bond beginners or bond masters individually. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.